Welcome. We start uh, our lessons for CPA foundation level. CPA foundation level. We are doing financial accounting, and the first topic of financial accounting is the introduction to financial accounting. Introduction to financial accounting. But before that, let me say that we have summarized financial accounting notes and answers to custom past paper question from 2015 to 2023, and we are giving these resources for free. If you want them, you can contact us through the email that is samuelgitudu20@gmail.com or samuelgitudu19@gmail.com. samuelgitudu19@gmail.com. Therefore, let us go to the introduction of financial accounting. And in this lesson, we are going to understand what is financial accounting, and then we go through the objectives of financial accounting, and then we understand the elements of financial statement, and finally we understand the users of accounting information. Who are these people that need the accounting information? And starting with the first objective, that is what is financial accounting. And we can first start by the definition of financial accounting. And financial accounting, it is an activity in business that involves gathering, classifying, organizing, recording, and communicating monetary information to the users of financial information to help them in making relevant decision decisions. Basically, that is how financial accounting is defined. It is an activity in business that involves gathering, classifying, organizing, recording, and communicating monetary information to the users of financial information to help them in making relevant decisions. When we are talking about business, you all know what a business is. A business is the activity established to earn profit. A business is an activity established by the owner to earn profit. Therefore, when the owners establish a business to earn profit, they need to know, are they making profit? And the tool that they use to establish whether they are making profit is by making a financial statement, keeping financial records, because the financial records will tell them how much they have sold, the amount of the expenses they have incurred, and the amount of profit they have made. Therefore, that is all what a business is. Then, in that business, therefore, there's an accountant who is gathering information. For example, when a sales occur, the accountant gathers that information. When a purchase occur, the accountant gathers that information. When an expense is incurred, the accountant is there to gather that information. Then the accountant classifies that information. If it is a sale, he'll have a book for the sale. If it is purchase, he'll have a book for purchase. If it is an expense, the same case, we are going to look at those books as we progress. Then the information is organized. The information is organized. They can be organized in a chronological order from the date at which that transaction occurred. Then it is recorded. Recorded. So basically, recording is writing it down in a book, and finally, that information is communicated to the users. Remember that information have to involve money. It has to involve money. There must be a transaction which involve money, whether it is a credit transaction, because a credit transaction means that money is going to be paid in future, and a cash transaction means that money is paid at that time. For example, if the business purchases stock on credit, then money is going to be paid in future. And if the business purchase the same stock on cash, it means a transaction involving cash has occurred. Then that information is communicated. That information is now communicated to the users to help them in making the decision that they want to make. So that is all about financial accounting. I repeat, financial accounting is an activity in business that involves gathering, classifying, organizing, recording, and communicating monetary information to the users of financial information to help them in making relevant decisions. Then we go to the objectives of financial accounting. What are the objectives of financial accounting in, in a business? The first objective of financial accounting is obviously to systematically to systematically record record tra, to systematically record transaction. That is the first objective of financial accounting, and we have said recording transaction means writing a transaction that is an event in a business which involves writing it down in a book in a systematic way. That means you're not just writing them down. There is a system in place which you are following. So that is the first objective of financial accounting. Then the second objective of financial accounting is to ascertain the result of recorded recorded transactions by preparing income by preparing income by preparing an income statement. You want to ascertain the result of the recorded. After you have recorded transaction, you want to ascertain the result by preparing an income statement. An income statement, um, an income statement basically it is a statement that shows your revenue and expenses. It is a statement that shows your revenue and your expenses. For example, if you have made sales, that is revenue. If you have incurred expenses, for example, the rent for the building, salaries for the workers, writing, electricity, those are some of the expenses. Therefore, if you a statement that contains the revenue, you deduct the expenses to get profit. That is what we call an income statement. We are going to discuss more about income statement in the lessons to come. The third objective is to ascertain the financial position of a business by preparing statement of financial position. You want to know the financial position of a business. A statement of financial position, it shows your assets, liabilities, and the owner's capital. A statement of financial position is a statement that shows your asset, liabilities, and the owner's capital. And we usually say that your asset, the total of your asset, should be equal to your liabilities plus the capital. Therefore, you want to know the financial position of your business. How is the business being financed? Is it being financed? Is a lot of finances coming from capital, or is a lot of finances coming from the liabilities? So you want to ascertain the financial position of a business, and that is the third objective. In future, we are going to prepare a lot of statement of financial positions. So this is just the introduction. And the third objective of financial accounting is to provide information to the users for rational decision making. You want to provide to the users of the financial information. You want to provide them with the information for them to make decision. In our third objective, we are going to see who are these users of financial information we are talking about. So basically, that is the fourth objective of financial accounting, that is to provide information to the users for rational decision making. And then the fifth objective is to know the liquidity position of a business. To know the liquidity position of a business. And when we are talking about the liquidity position, we are talking about whether the business is able to meet its current obligation. And the liquidity position is usually measured by comparing the current assets with the current liabilities. If the current liabilities are more than the current asset, then the business is not in a good is not in a good liquidity position, because it means that the business is not able to meet its current debt. Those are the current obligation. But if the current assets are more than if the current assets are more than the current liabilities, then the business is in a good liquidity position. So at this juncture, I don't want you to worry about what are current asset, what are current liability, because this is just the introduction. We are going to discuss the current asset and the current liabilities in the next topic. And the final objectives, and now the final objective of financial accounting is to know the solvency, to know the solvency position of a business. And the solvency position is whether the business is able, whether the business is able to meet its long-term long-term liabilities, long-term liabilities when they fall due. Long-term liability are liabilities such as loans. You have been given a long-term loan. If a business cannot meet its long-term liabilities, then that business is not in a good. That business is not in a good position, because in that case, the business can be dissolved, or it can go into a bankruptcy position when it is not able to meet its long-term liabilities. And that means that that business can fail at any times. So those are the objectives of financial accounting. And now we go to what are the elements of financial statement. Financial statement, we can first discuss what financial statements are. Financial statement, the first one is the income statement. That one we have discussed it here. That is one part of financial statement. Then we have a statement of financial position. We said income statement, it shows the revenue or the incomes of a business and the expenses. Then we have a statement of financial position, which shows the assets, and liabilities, and the capital of a business. So those are some of the financial statements. Those are some of the financial statements. Therefore, we are going to discuss what elements must financial statement have. And the first element is assets. All financial statement must have assets. And what are assets? Assets are resources. Assets are variable resources owned or controlled by a business for future economic benefit. Assets are assets are valuable resources owned or controlled by a business for future economic benefit. Examples of assets are, and these assets, they are classified into two major categories. We have uh, we have non-current assets, and then we have the current assets. Non-current assets are those assets which business intend to hold for a period of more than 12 months, for a period of more than 12 months. So these are assets like building. Example of non-current asset is building. We also have assets like motor vehicle. We also have assets like brand. Those are some of the example of non-current asset, but we are going to discuss more about non-current asset in the lessons to come. Then we have the current asset. Current asset are assets for asset in a business which the business usually holds for a period of less than 12 months. For example, we have trade receivable. Trade receivable, the business usually expect to correct those trade receivable within 12 months. We have inventory. The business usually expect to sell inventory within a period of 12 months. So basically, those are current asset. Current asset, they keep on moving. Then we have the second element of financial statement. We have liabilities. And liabilities, this is money that a business owes to outsiders. For example, a bank loan is a liability. Creditors is a liability because the business expects to pay. It is creditors. So those are basically what liabilities are. Liabilities are obligation that must be settled by the business. Then the third element of financial statement is what we call equity. And equity or capital, it is also called net asset. And equity or capital, this is the resources that are contributed by the owner of business. For example, when a sole proprietor want to establish a business and he contributes cash, that cash is capital or equity. So equity is the part, or the reason we are calling them net asset is because this is the part of the assets that remain after a business have paid all its liability. If a business can settle all its liabilities, then that portion that remain is the equity, or what we call the net asset. And then the other element is revenue. And revenue, these are incomes. So these are basically the income of a business. If a business make a sale, that's revenue. And then the final element are expenses, and expenses are costs that a business incurs in the process of doing business. For example, the rent for a premise. If you're conducting a business and you have rented a premise, then you expect that each month or whatever the period you have agreed with the person who is allowing you to use his premise, you expect to pay a certain amount of rent, so that rent is an expense. Electricity for the business, that is an expense. The salary you are paying to your workers, that's an expense. So these are costs that a business incurs in the process of doing business. And now we go to our final point, which is users of accounting information. We said that financial accounting, they are users, they are people who require the accounting information, and we are going to see these users. The first user of accounting information are the owners. The owners need accounting information. They need to know, yes, we have established a business. Are we making profit? Which product is selling more? Which cost can we reduce as the owners of business? Can we be able to uh, expand our business? So of the owners of a business require accounting information for various reasons such as those I have mentioned. Then the other users of the accounting information is the management. And the management, these are people who are entrusted to run a business on behalf of the owners. They are called the management. The management need accounting information to understand how efficiently the business is operating, to understand how efficiently the business is operating, to understand how products are performing, to understand whether the business is making profit, to understand which processes of the business to understand which processes of the business they can improve. So the management also need accounting information. The other users of the accounting information is the government. The government will require businesses to submit the accounting information each year to know the amount of tax that business is supposed to pay, to determine whether the business has paid enough amount of tax, and to determine fees that they can to determine the fees that government can charge in acquiring certain business permits. So that is the third user of the financial information. And the fourth user of financial information are employees. The employees need financial information to basically to understand how they are doing their work. For example, an accountant need financial information in doing his or her work, and an accountant is an employee of a business. Then they also need to know whether the business is providing the relevant benefit that is due to them. So employees are other people are also some of the people that requires the accounting information. Then we have customers. Customers also need accounting information to know whether their order will be delivered in time. They require to know whether the business is able to meet their future orders. So customers are also requires accounting information for such kind of purposes. Then we have the lenders, those who provide the business uh, with with money, or we can have the creditors here. They also need the accounting information to know whether the business will be able to to pay back its debt on time, and to determine which business they can be able to ready to, so and to determine the amount they can be able to ready to a certain kind of business. So readers also require accounting information. And then we have the investors. The investors require the accounting information to know whether to invest in your business or not. If your business is not performing well, then the investors will tell you to avoid that business. And if a business is performing well, then the investors will invest in that business so that they can also benefit from that business. And finally, we have the public. The public also require accounting information to basically determine the status of the economy, and to budget, and also to know about their retirement plans. Public is uh, uh, the public also requires accounting information. And that mark the end of this lesson, and I'll see you in the next lesson. Thank you very much.